Ladies and gentlemen, good day and welcome to Q3 FY22 earnings conference call of Ester Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Lisa from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and a warm welcome to Ester Industries Q3 and 9-month FY22 analyst and investor conference call. We have with us today Mr. Arvind Singhania, the Chairman, and Mr. Pradeep Rustagi, the Executive Director, Corporate Affairs. We will begin this call with opening remarks from management, following which we will have the floor open for an interactive Q&A session. Before we begin, I would like to point out that some statements made in today's discussions may be forward-looking in nature, and a note to this effect has been sent to you earlier. We trust you've had a chance to go through the communications and financial performance. I would now like to invite Mr. Singhania to make his opening remarks. Over to you, Arvind.
Thanks, Gavin, and thank you everyone for joining us today. I have alongside me Mr. Pradeep Rustagi, our Executive Director, Corporate Affairs. I will begin the call with a brief overview of all our businesses, post which Pradeep will walk you through our financial performance for the quarter. Starting with the headline numbers, we are pleased with our performance for the quarter, wherein we have delivered strong top-line growth of 43% over the previous year. The growth was largely broad-based, with all our business verticals performing well. So EBITDA in absolute terms is better as compared to Q3 FY21. EBITDA margins in percentage terms, however, was compressed on expected lines given the sharp rise in input costs visible across sectors. Eliminating the impact of increase in feedstock prices from raw material consumption and sales value, EBITDA margins during Q3 FY22 would have been about 26%. Moving on to individual businesses, starting with specialty polymers. As I have been indicating, demand momentum continues to remain strong, as can be seen by our volumes for the quarter, which enhanced by 59% over the previous year. Sequentially as well, we have seen a volume growth of 8%. Product offtake for both new and existing products remains strong, reflective of the underlying demand for the products. Sales of our marquee product MB03 remain strong, with volumes of 305 metric tons for the quarter as against 88 metric tons during Q3 FY21 and 240 metric tons during Q2 FY22. We expect this trend to sustain. Despite higher sales volume, our margins for the business though were marginally impacted on account of product mix not as good as the last quarter. As most of you know, specialty polymers is largely export dependent, and the overall margin profile varies with regards to customer mix, geography mix, etc. Sales of innovative PBT stood at 164 metric tons in the quarter as against 250 metric tons during Q3 FY21 and 284 metric tons during Q2 FY22. Innovative PBT is manufactured by us for a global chemical leader. Basis orders in hand and forecasts received from the customer, we expect to match the performance of last year and achieve significantly higher sales in both volumetric and value terms in FY22-23. Besides the legacy product, sales of our newly introduced products as well continue to remain strong. We are confident of scaling up the volumes for both existing and new products over the coming years, as well as given the strong demand we are seeing from our customers. Volumes of LMC03 as well, for which we recently started commercial sales, are picking up, and we are hopeful of seeing good volumes from this product over the next 2 to 3 years. Lastly, we are also close to achieving techno-commercial qualifications for our innovative product MB16. Steady pickup in volume for such products will help us significantly scale up revenue from this business. Moving on to the film business, Q3 witnessed yet another solid performance from the business and revenue expanding 35% over previous year and 15% over the previous quarter. Demand momentum remains steady, helping sustain the volume run rate. Domestic demand, as we have been indicating, is growing at circa 11 to 13% on an annual basis, which augurs well for the business on a medium to long-term basis. In the near term, though, demand supply may be slightly skewed in favor of the latter, with excess supply hitting the market, in turn exerting pressure on the realizations and margins. Our volume for the quarter stood at 14,248 metric tons as against 14,299 metric tons in the corresponding quarter last year and 14,591 metric tons for Q2 FY22, translating into a marginal dip. Despite the low volumes though, Consequent to higher feedstock prices, selling prices on a sequential basis have improved. Higher proportion of value-added products also contributed to higher realizations. We are working, as we said, towards increasing the share of value-added products, and I'm happy to report that we have been making steady progress towards that. The share of value-added products during the quarter stood at 23% compared to 20% during the previous quarter and Q3 FY21. Our aim, as we have hinted earlier, has been to increase the share of high-margin products to 30% of the overall product mix, and we are well on track towards attaining that. We are confident that the better product mix will help us sustain the overall profitability of the business. Commissioning of our new 48,000 ton per annum plant in Telangana in October should help us further scale up the growth and profitability profile of the business. Moving on to our engineering plastics business, Q3 was a good quarter for the business with good revenue momentum. Our volume for the quarter stood at 2,910 metric tons as against 4,420 metric tons during Q3 FY21 and 2,974 metric tons during the previous quarter. Reduction in volume is vis-a-vis previous quarter is mainly on account of lower demand for OFC grade engineering plastics. Volatility in OFC volumes quarter to quarter is a regular phenomenon. Though demand for EP compounds improved in the festive months of October and November 21, the slowdown in auto sector, especially two-wheelers, impacted demand in the month of December. Better pricing and margin environment resulted in higher profitability for the business as compared to Q3 FY21. EBIT margins for the quarter stood at 21.3% as against 19.1% during Q3 FY21 and 23.7% registered during previous quarter. Higher margins during the current quarter were despite having limited holding of low-cost inventory. Akin to pill business in EP as well, our objective is to improve product mix by increasing the share of value-added products. We are also confident that the relocation of the unit will not only help us better serve our customers, but will also help us in sustaining margins by lowering operating and logistics costs. To conclude, I would just like to state that all our businesses are well positioned to embark on their next growth phase. Specialty polymer has revived well on expected lines after a challenging year. Demand momentum for legacy products remains strong, while newly introduced products as well have been garnering favorable response from the clients. Product pipeline as well continues to remain encouraging, giving us the confidence of sustaining the momentum over coming years. Pill business as well continues to perform well. Demand in both domestic and export segments remains steady, helping sustain the volume momentum. Realizations as well are expected to remain steady in the medium to long term, although in the near term, though one can expect some pressure owing to excess supply. Besides favorable macros, our efforts towards improving product mix by increasing the share of value-added products and commissioning of new units should help us improve the margins and profitability trajectory of the business. Engineering plastic business as well is expected to perform well, supporting the film and specialty polymer businesses. EP has seen a sharp revival in the last 6 quarters owing to shortage of feedstock material, increasing prices of feedstock and revival in demand post first wave of COVID-19. We expect the trend to sustain in the near term. Furthermore, the relocation of the unit should also help us in sustaining the profitability and margin profile of the business. That concludes my opening remarks. I now hand over the floor to Pradeep to walk you through the financial performance. Thank you.
Good evening, everyone, and thank you for joining us today. I will quickly walk you through our financial performance for the quarter and 9 months ended December 31st, post which we can begin the Q&A session. Starting with the top line, revenues from operations stood at rupees 365 crore as against rupees 256 crores reported during Q3 FY21, that is higher by 43%. On a 9-month basis, revenues stood at rupees 1017 crores as against rupees 695 crore, higher by 46%. The growth has been largely broad-based as all the businesses have seen good traction in their revenues. EBITDA for the quarter stood at rupees 64 crore as against rupees 58 crore generated during the Q3 FY21, higher by 10%, while on a 9-month basis, the same stood at rupees 187 crore as against rupees 183 crore generated during 9 months FY21, higher by 2%. Margins in percentage terms, though compressed during the period in the review, largely owing to sharp increase in input costs and freight expenses. Finance cost for the quarter stood at rupees 6 crores as against rupees 4.7 crore outgo reported during Q3 FY21. While on a 9-month basis, the same stood at rupees 16.3 crores as against rupees 13 crores outgo reported during 9 months FY20. As of December 31st, 2021, Our outstanding interest-bearing term debt net of free cash stood at rupees 190 crores, while interest-bearing working capital liabilities stood at rupees 92 crores. Interest-bearing debt net of free cash as a multiple of annualized EBITDA remained at a comfortable level of 1.13 as of 31st December 21. We are committed towards maintaining prudent debt equity level and will not jeopardize our balance sheet at the cost of growth. Depreciation for the quarter stood at rupees 10 crores as against rupees 9 crores reported during Q3 FY21. While for the 9 months, the same stood at rupees 29 crores as against rupees 27 crores during 9 months FY21. Profit for the quarter stood at rupees 36 crores as against rupees 33 crores generated during Q3 FY21. While for the 9 months, the same stood at rupees 106 crores as against 108 crores generated during 9 months FY21. To conclude, I would just like to reiterate what Arvindji had said earlier. All our businesses are well positioned to deliver consistent growth and drive the next phase of growth for the company. Thank you.
Thank you. Should we open the call for Q&A? All right. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. The first question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So my question is for the BOPET segment. So can you talk about the contribution margin in the segment and where do you see the spread moving going forward?
Sorry, can you repeat the question? Your voice is not very clear.
Okay. So I'm talking about the contribution margin in BOPET segment and how is the spread is going to move forward?
BOPET film. You're talking of the value addition or the contribution margin in BOPET film business?
Yes, yes. And the spread.
Yeah, so spread is nothing but value addition, which is the selling difference between selling price and raw material cost. So in the September 21 quarter, it was for a 12 micron Corona film, it was 36 rupees. December it improved to 46, and currently it is in the range of 62 to 64 rupees a kg.
Okay. So do you think this spread, the moderation in the spread from this level?
I'm sorry, your voice is not clear at all. I can't hear you.
Are you on a speakerphone? Can you use handset?
Yes, Mr. Kumar, can you please come on the handset mode if you are on speaker?
So, my question is, do you think this spread is going to sustain? What kind of moderation you are looking is going to be happened in the coming quarter?
In the medium to long term, the margins will remain healthy, although in the short term, with the startup of some new capacities, it could moderate a little bit.
Okay. So this, see your other competitor is also talking about the supply side. So can you talk about the supply in the industry, where the supply is going to come and how much, whatever we have seen a volatility in the business and the margin is in the higher side. So from here, how much supply is going to come and what kind of moderation you can see in the margin?
So in this year, we expect about 3 lines to start up, 3 to 4 lines, including ours, which is a total capacity of about 120 to 150,000 tons per annum. Of course, when a line starts up, it doesn't start producing 100% straight away. So it always takes a few months for capacities to build up. So on an average, this year you could see, if nameplate capacity is 150,000 tons, you could see additional capacity of about anything between 80 to 100,000 tons in effect, coming into effect this year.
22-23.
In 22-23.
Okay. So in that case, you see the supply is going to hit the realization as well as the margin.
Yes, there may be some moderation in the margin.
Okay.
But there is a healthy demand growth in the film business.
Okay.
And well, of course.
Thank you so much.
Thank you. The next question is from the line of Alpesh Lat from Dolat Capital. Please go ahead.
Yeah, hi. Good evening. I just had two questions. One is regarding the specialty polymer segment. We have seen a decline in sequential margin. So is it mainly because of lower share of IQBBT, or is there any other reason for the same? And do you see the margin contraction going forward as well?
No. There is no margin contraction going forward. It just this is an aberration because of product mix. Every quarter doesn't have the same product mix. Sometimes the product mix may be a little more favorable than the other quarters. That's why you see this. It's the variation rahegi hardam in
Okay, fine. And my second
margin, because margins here are pretty much fixed in all the products.
Rupees per kg is fixed.
It's fixed.
Right.
As a percentage, you may see the drop in margin, but that is because raw material prices have doubled over the last 1 year. And with the margins being in fixed rupees per kg, then the percentage margin will fall, na?
Right. Okay, so we have a.
We don't expect these high raw material prices and crude to remain at $90 a barrel or $95 a barrel. As soon as the crude oil starts moderating, raw materials will moderate, the selling prices will come back. Margins in rupees per kg remaining same, percentage margin will increase.
Okay, fine. And the second one is in engineering plastic segment. What kind of momentum do you see going forward, and do you see any challenges from the crude oil prices, rising crude oil prices?
See, crude oil prices affects the price of raw material, and like I've always said, it's a pass-through model. So raw material prices went up, we were able to pass this through. Margins remained healthy despite the increase. And when the raw material prices, the crude will come down, raw material prices will come down, our selling price will come down, but hopefully the margins will remain the same.
Okay, fine. So we are right.
Yeah,
right.
We are bullish about the engineering plastics.
Okay, fine. Okay, sure. Thank you. That's my side. Yeah.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah. Namaskar Singhania ji, Namaskar Rastogi sir, and thank you sir for this opportunity. Sir, firstly, you were speaking about the new capacities that would be on, that are in the annual to be on stream. So if you could give more color, what kind of in volume terms and from which geographies are these capacities going to be?
Geography of India hai. The capacities are coming up in India. कुछ जैसे हमारी south में आ रही है. There are some coming in the north. Some will be in the central part of India or western part of India. Total capacity increase expected. Nameplate capacity increase is going to be about 130 to 150,000 tons. इसका actual effect in terms of volume terms in this next financial year in FY23 should be in the region of 80 to 100,000 tons of additional capacity in practical terms.
Okay, sir. And globally, how things are in the pipeline? What kind of capacity addition we are seeing on the global scale?
On the global scale, most of the capacities are coming up are in China. So China is no threat to us.
Right, sir. Sir, if we look at the size of the market and the import that the country takes, how is the dynamics going to change post this expansion? Firstly, the incremental demand, and secondly, the what percentage is imported in the country?
Very little is imported into the country. Imports are negligible. We don't have an import threat.
Okay, so then how is this capacity going to get exhausted? What is the incremental demand, and what kind of additional capacity then will be in the system, sir?
Yeah, so the additional capacity will get used up because of the increase in domestic demand, which is about 11 to 12% or 13% per annum, and plus global demand is growing at about 5 to 6%. So there will be exports will increase, and it will get consumed with the increase in domestic demand and global demand.
Thank you. I would request Mr. Kapoor to rejoin the queue for follow-up questions. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yes, sir. Sir, one question regarding this capex and debt. So if you could just explain this slide number 30, this total capex including is 587 crores?
Yes.
And how all of these for
quality? That is in the subsidiary Ester Film Tech, the project coming up in Telangana.
Wholly owned subsidiary.
Hello?
Yes, sir.
So the 584 crore capex is in the wholly owned subsidiary of Ester called Ester Film Tech, which is implementing the 48,000 ton per annum film project in Telangana.
Okay. And you have given certain projections. This is basically your assumption of the revenue and profitability subsidiary will make in 24 and 25, right, sir?
Yes.
Okay. But which would mean that our debt will go up significantly, right, to almost 500-600 crores post this plant getting commissioned?
On a consolidated basis, but EBITDA would also go up.
The EBITDA would also go up, na?
And sir, what type of assumptions? Because if I see before this upstream started, the EBITDA margin used to be in the range of 15 to 17% in the film business. Currently, they are at 28-30, and we are projecting around 24%. So, what gives us the confidence that, and with this so much of capacity coming in, this 23-24% margin we will be able to achieve?
See, please understand, there may be short-term volatility because of capacity, but in the medium to long term, and with the increased capacities and economies of scale coming into play, and the Telangana project the cost of production is going to be much lower. So therefore, it will have a big impact on the margins for Ester.
Okay. But sir, any numbers that you can share with us over a 2-3 year period? What is the peak debt to equity that you are comfortable with, or debt to EBITDA you are comfortable with?
Sachin, we can talk to you on this offline.
But it will always remain prudent. So let's say we'll always remain below 3 times, much below 3 times EBITDA. More like 2 times EBITDA.
Okay. Thank you.
Thank you. The next question is from the line of Rahul Kulkarni, an individual investor. Please go ahead.
Yeah, hello. Hi, this is Rahul Kulkarni. I just had a few questions. One, in terms of the capex plant which is there, which is coming up, what is the current status? Because last time I think land leveling works were going on. So what exactly is the current status of that
okay. So
percentage progress?
Yeah, so the project timelines are running absolutely on schedule. Okay. And we are way beyond the land leveling. Our building is complete. Erection of plant and machinery has started. And we are absolutely on time in terms of commissioning of the project, which is in September, October this year.
So basically Q3 FY23, the revenue from that plant should kick in.
Absolutely. Well, it will start.
It will start. I understand it would be a gradual scale, but it will still start.
Yeah, in Q3, we will definitely start our production.
Okay, got it. That is one. Second, in terms of, in one of the questions which you answered, you mentioned the spread has gone up from around 46 rupees to around 62 rupees. So if this same for the, I think, basic film which is there, so if that, is it fair to assess that that would exactly, if the same momentum is to continue, you will see a drastic increase in the margin for Q4? Well,
Q4 is also looking good up to now.
Okay. So is like 14 rupees per kg, which was mentioned, like from 46 to 60 to around 16 rupees?
No, January was lower.
Yeah. So this is a February number. January was a little bit lower, 57 rupees. So like I said, the Q4 is looking good, better than Q3 in terms of film.
Okay. And for that, you mentioned that freight rates were also the reason. So how are, from export point of view, how are the freight rates now? Have they reduced?
Freight is still extremely high, but the prices have gone up, freight rates have gone up, everything has gone up. I mean, the world is feeling the pinch of inflation and high rates in commodities across the board.
Understood. Got it. In terms of specialty polymers, you mentioned that the product mix has been one of the reasons for, the slight change in the margin. So in terms of this innovative PBT, which I could see in terms of drop in terms of volume, is this innovative PBT, we had a contract renewal which was supposed to happen. So has that contract been renewed, or do the margins, do the volumes continue from that player irrespective of the contract?
No, we discussed with them. There is no need for contract renewal. They're buying. They've given us a forecast, and this year our volumes will be similar to last year, and next year we hope to almost double it.
But any specific reason why there was a drop seen on a year-on-year basis?
It's not really a drop. It is virtually the same. If
you annualize the 9 months data, you will get the same number as we achieved last year.
There's no drop.
In the 9 months, we have done 792 as against 1042 last.
Are there?
Sorry?
Annualized number remains more or less similar, but there will be quarterly fluctuations based on requirement of the customer.
And they are increasing volume, and they have given us a clear indication that next year's volume will be substantially higher than this year.
What is it possible to mention? What is the FY23 estimate volume for innovative PBT?
2,000 tons plus.
2,000 tons plus. Okay. And what did we do in FY21?
Close to 1,050. 1,000 to 1,050.
Okay. So expected. And what has been the 9 month number for innovative PBT?
792 tons.
790. So broadly, we are looking at doubling. That's what the broad.
Yeah. That's the indication that we've been given.
Okay. And when just one last question on the engineering plastics plant. So when are we looking to complete that shifting to the new place, which will improve the margin?
It should be over by about August, September.
22.
Yeah, correct.
So land has already been acquired.
Understood. So again, for that also the Q3 numbers should get reflected, should result in the improvement in margins for that.
Q3 you start seeing the difference, yes.
Okay. And how much is it quantifiable? What broad level of impact it has?
I think just the shifting should improve the EBITDA margins by anything between 1 to 2%, just because of shifting.
Okay.
Because saving in logistics cost.
Okay. And you were doing some capex also for the engineering plastic, if I'm not wrong. So where are we on that?
The engineering plastic business is being shifted. So
okay,
there will be capex involved, and we are increasing capacity also by another extruder.
Okay, so when would that be completed?
That's what I said, August, September.
Okay. So the shifting and the additional extruder, both
going together.
Okay, they're happening together. Understood.
Yeah.
Okay, so only shifting will result into 1-2% increase in margins, and obviously whatever extra you can sell because of the additional capacity, that would result in the additional revenue and margin.
Additional revenue, additional margin, yes.
Yes. Okay. Yeah. Thank you so much, and congratulations on great set of results.
Thank you.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Sir, regarding the share of value-added products in the film segment, if you could tell us a bit, I think in 2 years between 2020 when it came down, this year again it has gone up. So how do we see this share of value-added in this FY23 and post the commissioning of new plants? What is the type of plans in terms of increasing share of value-added products?
Can you just please repeat once? I'm not very clear with your question.
I'm saying the share of value-added products in the film business it had gone, especially on again this has gone up to 23%.
Right.
Commissioning plan, how do you see the share of value-added products in 2 to 3 years in the film business?
After commissioning of new plant, in the initial period, the new plant will start contributing to large commodity products, and slowly, steadily, the proportion of volume from that plant also will be shifted to value-added products.
Basically, this 23% is based on our existing capacity. Once the new capacity is added, the absolute number of value-added product will go up, but as a percentage it will come down because you have to add the denominator goes up.
Sure. And how do we classify, sir, value? What is our benchmark for that?
The benchmark is a certain amount, additional value add per kg that we get. So let's say if we're getting more than 20 or 25 rupees per kilo, then it's classified as a value added product over and above commodity film.
Okay. No, because the commodity margin itself have gone up. So that's what this is creating a little bit of confusion. It is linked to the margin superiority that you get on commodity. It is on absolute number because the commodity margin itself has gone up significantly in the last 2 years.
Yes. So it is over and above that.
It's over and above. Okay. So it's always linked to the commodity. So commodity moves. If commodity is 10 and 12, then it's valuated. If commodity is 20, we should get 20 or something like that, right?
Value-added products have to bring in more than commodity margins.
At any point of time. Okay. Okay. And do commodity margins fluctuate? So if commodity margins were to come down because of the extra capacity, will the margins, commodity, specialty and value also come down accordingly?
No, not necessarily. It depends on raw material pricing. And in some cases, it is linked to commodity. In some cases, it is not linked to commodity. So in some cases, if raw material prices were to come down, some products, the margins, absolute margins will also reduce, but still be higher than commodity. And in some cases, it is not linked to commodity, where the margins, if raw material goes down, will increase.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yes, sir. Thank you, sir. Sir, I missed the percentage of value-added films in our this quarter numbers and for the 9 months.
You want the absolute volume?
Give volume as well as the turnover.
Yeah. So just
and secondly, sir, how the raw material basket has shaped up as sir has spoken about raw material prices moving up significantly year on year. How have the price movement has been quarter on quarter? And then another 2 small questions and I'm done.
First, I'll share the proportion of value-added films in terms of volume and value in the total sales value of film business. So in June 21, we did 20%, but whereas value was 28.5%. In September 21, again we did 20%, but value addition, the value proportion was 28%. In this quarter, we have done 73% in volume terms and 31% in value terms.
70, sir? Last word, 71%?
31%
in value terms.
Okay. And volume terms?
28%.
28%. Okay.
23%.
So this what should be the trajectory, sir, for a sustainable and as a sustainable ballpark number? In what bracket are we expecting the value-added film contribution to be going forward?
Our target is to touch 30% in volume terms based on current capacity.
And so when we will be, when the new capacity will be upstream, what kind of value addition are we contemplating there? And if you could give some more color on it.
See, once the new capacity starts up, our total capacity will almost double. So as a percentage, value-added proportion will fall as a percentage after the startup of new capacity. But over a period of time, our target is again to take it up to 25-30% of total volume.
Right. So no. So when we are putting up this new capacity, are we coming up with the extruder and the metallic film, what we have done earlier to introduce value-added segment, or this will be a plain vanilla film?
No. We are putting up metallizer. We are also going to put up another coater. So this will help us to achieve our overall target of 25-30% of the overall capacity.
Okay, sir. Sir, firstly, sir, also congratulations on the revamp in the presentation for investors. Sir, this volume part and all are really making a lot of sense for us in understanding the numbers. So thank you to the team for making these very good changes. Very informative, sir. And sir, coming to the raw material part, sir, if you could dwell more into it, sir.
Raw material, as you know, I've already mentioned in my discussions here that raw materials have almost doubled over the last 1 year, largely on account of increase in crude oil prices. And crude oil, as you know, has gone from $40 a barrel to $95 a barrel today. And therefore, there has been a phenomenal increase in raw material prices. And we don't know, I can't predict where oil will go in the future, whether it will continue to go up, remain steady or go down.
Yeah.
But
only the breakup I am looking, sir, for the raw material basket ka breakup within MEG, PTA prices. What have been the price trends Q and Q, sir?
You want quarter by quarter?
The last 2 quarters comparison, if you could give me how the June shaped, how September shaped, and how December quarter.
Yeah. September the PTA was 66 rupees. Then it increased to in December quarter 68.5, and currently it is 72. MEG in September was 55. In December it was 60, and now it is currently at 61.
Right, sir. So these are the major components, sir, for this. And coming to this, sir,
biggest component.
Biggest component. Correct, sir. Sir, I missed your point when you explained that even on the higher volumes, the margin for the film segment. So what was the key reason? Is it only the product mix part which you have explained, or any other thing, sir? When we look at the volume numbers, even when we look the numbers for say quarter 2 to quarter 3, the volumes have dipped by I think so from 14,000. This is for
hardly any dip. It was almost the same.
Yes.
Yeah.
Margins in absolute terms have improved, but as a percentage have gone down because of increase of raw material.
Okay. Right, sir. And sir, lastly on this, our engineering plastic segment, sir, what is the update on the relocation, sir? And are these numbers sustainable, sir? Earlier we were.
I've already answered that question. That the relocation is going on well. It will be finished by August, September.
Okay, and these margins are sustainable over a period of time. Now we are building on these margins, sir. If we take every quarter numbers, we are seeing improvement, and also on a longer term horizon, what should be the base margin, sir, for this segment?
I think the margins, we're expecting these margins to sustain over the short to medium term period.
Okay. So because sir, what if I can recollect, sir, earlier it was, I think so, the shortage and or because of the pandemic effect that we started posting these higher margins of 20% for this engineering segment, plastic engineering. And at that time,
the effect of COVID has not gone as yet. The world is still facing the effects of COVID. Trade rates have tripled or quadrupled. Raw material has doubled. I mean, if you see across the board, across all commodities, across all sectors, whether it's steel, whether it's cement, polymers, anything and everything, the prices have gone through the roof. So COVID effect has still not finished. COVID may finish very soon, I'm hoping, but the effects of COVID may last for a while.
Correct, sir. So just to sum up, quarter 4 as of now, barring I think so the January month, which Rastogi Sahab has also articulated, is shaping up better, and we can look forward for similar or better volumes in all the segment for Q4 ending March 2022.
I will just say that Q4 is looking better than Q3. And that's it. I don't want to elaborate.
Right. Yes, sir. Only on the volume and the utilization level, sir. Are we contemplating better volumes for?
I think at the end of the day, what matters is profitability.
Correct.
And the profitability looks better in Q4. Correct. As of now.
Correct, sir. And lastly, sir, on the net debt number, sir, if you could share, what are the net?
Net debt is about 280. Working capital and term loan put together is close to 280 crores.
As of today.
As of 31st December 21.
Okay. And how much has been drawn for the new plant at Telangana, sir?
That is in the subsidiary.
So you give me the net consolidated number, sir.
Consolidated is 280 plus 46 plus close to 500 crores.
Okay. For the project in specific, sir, how much have been drawn, and how is the capex planned for the next year?
For the wholly owned subsidiary, we have drawn so far 250 crores. Okay. Foreign currency and rupee debt put together.
Okay. And what will we be closing this year, sir? For March, कितना draw कर लेंगे?
But I think you should not count the debt of the subsidiary, because that's a plant under commissioning. That's operative. That's work in progress. That should not be looked at this stage. That the right time would be the March of 23.
Okay, sir. But on a whole basis, sir, it will impact the numbers. Even in CWIP also, it will create, it will be lumpy figure over a period of time when the things will get capitalized. But we will get a fair idea of how things are shaping up. That was the reason for the same.
Fair enough.
Yeah. Thank you, sir, for answering all the questions, and thank you again for the presentation, sir. We hope, looking forward for a good trend to continue, sir. Thank you. Thank you again.
Thank you. The next question is from the line of V. Surendra, an individual investor. Please go ahead. Surendra, your line has been unmuted. Please go ahead with your question. We would request you to unmute yourself from your handset and ask your question. Surendra, please unmute yourself and ask your question. There seems to be no response from this line. Ladies and gentlemen, you may press star and 1 to ask a question. Anyone who would like to ask a question, you may press star and 1. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you everyone for attending this earnings call for Q3 FY22, and I look forward to seeing you for the next earnings call for the full year of FY22. Thank you very much.
Thank you. On behalf of Ester Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.